Everyone, hope your new year is off to a good start. Today, Jim Sr. and I will be presenting our 2022 market outlook titled Passing the Baton. Stay tuned. So what do we mean when we say passing the baton? In our view, it comes down to who drives the economic expansion going forward. Since March of 2020, the primary driver has been our federal government and a lot of stimulus that's come down from Congress and the Federal Reserve. Well, that's all winding down. And for this economic expansion to continue, it's going to primarily depend on the individual choices of consumers and households, and what small business does and what companies do to organically grow the economy moving forward without a lot of the stimulus that we've seen over the past 2 years. To elaborate on our economic outlook, as well as our outlook for stocks, I'll hand it off to Jim Sr.
Let's take a look at forecasts for this year and how they fared against last year. And I'd also say, if you look back to last year when we did our Outlook 2021, the numbers were, I think, pretty in line with what actually happened. So we're happy about that. So this year, we think that global growth rates will be somewhere around 4.5%. And that's a compilation of, U.S. developed markets and then emerging markets. We think U.S. will be the place to be, like it has been for almost 10 straight years. And at some point, that's going to change. But we think this year, again, it'll be the place to be, where we'll have 4 to 4.5% growth. Europe and international developed markets will be in the range of 4% growth. And then emerging markets, somewhere between 4.75% and 5.25%, let's call it 5% growth. It'll be an exceptionally good year, at least from a historic perspective. Now, 2021 was off the charts. We had global growth of almost 6%, and here in the U.S., we were about 5.5%. Jim's going to talk about bonds a little bit later. I'm going to just touch on inflation, and I'm going to make a comment. Inflation, we believe, will settle down. It might take 6 months, it might take another year, but we're going to sort through these problems. And the end result is that we are going to have higher inflation than we did going into the pandemic. But keep in mind, we've had very low inflation for 20 years. And if we have a little bit higher inflation, it's actually good. And I'll talk about that a little bit more on the next slide. But here, if you look at the yields on the 10-year Treasury, note some people are saying that interest rates are going to really move up this year. We don't think they're going to move up as much as people think, because you have countries all over the globe that have negative interest rates, and all those interest rates have been moving up. They're still negative, and they have to invest in fixed income, and we're the choice. We've got the safest debt in the world, and we have some of the highest yields. So we don't think the 10-year note will increase much more than 2, or finish the year, I should say, much higher than 2%. It may throughout the year go higher, but that's our stand. This year, well, looking back at 2021, we started the year, interest rates were about 1%, a little bit less, but let's call it 1%. And then finished the year, for the most part, at about 1.5%. And then just, in the last few days, we've seen the 10-year note jump to 1.75, which is where it is right now. So it'll be interesting. Yes, we think interest rates will go up. No, we don't think they're going to go up as much as some people think. If we look at inflation going back, I started in the business back in right around here in '82. And so, Bridget and I bought our first house. I think our mortgage rate was 14 or 15%. People are referring back to the Carter years with this high inflation of 16%. We don't think that that's where we're headed. And a lot of people are saying this, and we just don't buy it. We could be wrong, but this is our view. If you look at the last 20 years, inflation has averaged under 2%. So yes, we're going to have higher inflation going forward, but we think if it's 2.5 to 3% once this inflation settles down and we can figure out the supply chain issues and there's more supply put into the economy so that the demand goes down and you see commodity prices perhaps fall and technology is going to be here to offset some of the increasing labor costs. We think there's reason to think that things will settle down. And when they settle down, if inflation in 2 or 3 years is around 3%, we think that's a healthy thing for the markets and the economy. So that's our view on inflation. If we look at the stock market, I'm going to start off by saying something, and Jim and I have said this really for the last 4 or 5 years. And I'll go back to the Obama administration. There are some people who thought the stock market was going to do horrible under the Obama administration. They were thinking politically. And they were wrong because it was a great 8-year period for the stock market. People really were rewarded for being in the stock market. Trump comes along. Many people thought that it was a disaster and the stock market was going to plunge. They were wrong. Under Trump, the stock market did really, really well. Biden gets in and, half the population thinks the markets can go to zero. It's a disaster. They're wrong. Last year was a great year for the market, and we think this year is going to be good too. So please put the politics aside. And we are happy to say, Jim and I, that we have talked with, many of you who were concerned about either, an Obama or a Trump or a Biden. And, you stayed the course and you were rewarded. But there are a lot of people, outside of our clientele, I know they stayed in money markets because they thought that they were outsmarting the stock market, thinking, politically, and they were wrong and they've missed out on a lot of gain. Okay, so let's take a look at forecasts for 2022. First of all, LPL Financial, the research department believes that we're going to see the S&P 500 move up to the 5,000 range. It's currently about 4,700. So that's a 6% increase. And if you include dividends, that's about an 8% total return this year for the market. Now, it could be low double digits. And again, we could be wrong and the market could actually fall this year. But that's not what we're thinking. We're thinking the market will go up. And I'll get into some of the reasons. We believe that the earnings will be at around $220 on the S&P 500, which can justify the market moving up. And it's interesting, but at the end of 2021, the PE ratios were a little bit lower than they started the year. And you might say, how is that possible? The higher the PE ratio, the more expensive the market. So if the market went up over 20% last year, how could the PE ratio actually stay the same or go down? Well, the formula, price divided by earnings, the price goes up, but if the earnings go up more than the price, you actually see a falling PE. And that's what happened last year. If we take a look at the economy and where we are, the different phases, we believe, as I think most people would agree, we're in a mid-cycle economy. This tends to be really good for stocks. The S&P 500 has risen 80% of the time during these mid-cycle years with an average gain of a little over 11%. They typically last a little bit longer, and they typically are accompanied with low interest rates, good earnings, good growth. And so another reason to be a little bit optimistic about 2022. Stocks tend to rise the year before the first Federal Reserve rate hike. And we think we're going to see a tremendous amount of volatility this year, opposed to last year, where we only saw a little more than a 5% peak to trough correction in the market, or blip. And some of you got nervous about that, but it was very unusual. This year, we're going to go back to more of the normal corrections, which on average, if you go back decades, about 14%. And the averages, we understand, can be misleading, but that's really the average, type of fluctuation you see in a typical market. During midterms, when you've got elections going on, these fluctuations can even be 17, 18%. And we think this year is going to be the year we see some of these wild corrections. And we say, don't fear them, welcome them. And if you're looking to add money because you've had more money in the money markets than you wanted to, this might be a good time to add, because we think and expect this to happen. We also expect the calendar year to be a positive for the stock market. Unfortunately, there are no guarantees. And that's the real cost, the cost of investing, because you don't know the future. But again, we feel that this will be a reasonably good year. And we're also going to see a lot of volatility. We've got rising interest rates, which for some reason puts the fear into people. And I think the media has a lot to do with it. And then we have midterm elections, which again, this uncertainty is not good for the market. In reality, most times during mid-term, and don't confuse that with the mid-cycle part of the economy, but the midterms that are coming up, typically it's pretty good, because once the elections are decided, then we've got half of November and all of December where there's certainty now with the market, and market likes certainty, so the market typically moves up. And as far as the interest rates, when we see the Federal Reserve raise interest rates for the first time in that cycle, usually very good for the market prior to that increase, and then even going 6 months out, the history shows that majority of times the market's higher after that. And it's really not till a third, maybe a fourth interest rate hike where the markets, then you maybe view them a little bit differently. So we want to comment on, the midterms, which can be volatile, but probably pretty good. And rising interest rates early on are going to be viewed as fearful, but pretty good typically. And if you look historically at the market. Let's talk about earnings. In 2019, the S&P 500 had $163 of earnings. In 2020, it dropped to 140. And I will tell you, we thought it would be much lower than that. But there are a lot of these at-home stocks that did really well. So there are a lot of companies that made a lot of money. A lot of the technology stocks did very well. But you can see there was a drop in earnings. And of course, we saw what happened to the stock market too during this period of time. Dropped almost 35%, and then it finished up really strong. 2021, look at the increase from $205 of earnings from 140, more than people thought. And then in 2022, it's being projected and forecasted that we're going to see really a pretty good year for earnings as well. So those are our comments on the economy and on the stock market. Jim is going to share his views on the bond market and maybe a few other things. So thank you. I wish you, along with everyone here at Latina Financial, a happy and healthy New Year. And if you need anything, feel free to give us a call. All right, thank you, and over to Jim.
Now moving on to our outlook for the bond market. In 2022, we expect the 10-year Treasury yield to end the year between 1.75% and 2%. So between where it is now and a move moderately higher. Factors contributing to this view are the improving growth expectations once the Omicron variant recedes, the most recent CPI reading coming in at 7%, and a more hawkish Fed looking to hike interest rates possibly 3 to 4 times this year. With that said, returns in the bond market are likely to be flat to low single digits. Not a great year, but we should see an improvement over the negative fixed income returns we saw in 2021. In terms of returns for the bond market in 2021, we're coming off one of the worst years that we've seen in decades. Now remember, there are a few reasons why bonds play an important part in a portfolio. They're a diversifier, and they'll likely do well when stocks are down. But we also keep them in the portfolio for stability, and bonds can act as a volatility absorber. Having bonds in your asset allocation, even if the returns aren't stellar, may keep us from selling out of our stocks at the worst possible time. Bonds, particularly core bonds, have been less volatile than stocks and have historically provided balance to portfolios during equity market drawdowns, which as we know, are normal occurrences from time to time. As you can see here, the maximum drawdown for bonds in any given month has been dramatically less severe than stocks. While the worst drawdown in 1 month for equities was negative 28%, the worst bonds have done during 1 month was negative 6%. So when combined with equities, bonds help reduce total portfolio volatility, which makes for a smoother investment experience for clients. And with that, we'll wrap up our market outlook for 2022. If you have any questions at all on stocks, bonds, the economy, or anything else, please don't hesitate to call. Thanks and take care. Thank you for viewing our Market Outlook 2022 presentation. Please see below for these important disclosures.